In today's video, we're going to talk about closing costs. My hope is that you'll have a better understanding of what they are, who pays for them, and when they're paid for. I'm going to speak more to the buyer's side for the first-time home buyer. I'll discuss briefly some of what might be on a seller's settlement statement. So if that's of interest to you, then stay tuned. My name's Laura Gallant. I am a full-time realtor here in Colorado Springs, Colorado with ERA Shields. In today's video, we're going to talk about closing costs and help you to understand them better. What's involved in them, what's paid for in them, when are they paid for, who can pay for them, and a little bit more about the seller's side, but I'm going to focus on the buyer's side. This video is part of my first-time home buyer series. So stay tuned and let's get to it. Every transaction has two settlement statements, one for the buyer and one for the seller. In today's video, we're going to focus more on the buyer settlement statement. So what's involved in it? Well, the settlement statement will have a variety of costs. It'll have the loan processing fees that you pay to the lender on that document. So that's where you're going to be paying that fee. You might have your appraisal fee on there from the lender. There'll be HOA fees paid in advance if there happens to be a homeowners association involved. You're going to pay the title insurance for your owner's policy as well as your lender's policy. And that's to ensure that your name is on title and that the lender is in first position. You're going to have points that you might have been paying to the lender to get a lower interest rate. So that fee will be on there. Your entire first year of property insurance will be on that statement because they want to make sure that the home is properly insured. So that entire fee will be there. The title company has a fee for processing and settling the transaction. So they will have a fee. There will also be for the lender what's called escrow accounts. And the lender collects ahead of time 3 to 5 months for both the property insurance and the taxes. And that starts an account for them, and the rest will come on your monthly payment because you're going to pay principal, interest, taxes, and insurance within your payment. But to have enough to pay that bill when it comes due in 12 months from now, they will also start an account, an escrow account. So you will have 3 to 5 months, depending on what time of the year the transaction closes, for taxes as well as your property insurance. So you will see those costs on there. What you won't see as the buyer is the cost that pays the realtor. In the state of Colorado, that transaction side is usually paid by the seller. And so that fee will come off of the seller's settlement statement. Now, those are some of the debts that you'll be paying in the closing costs at the end of the transaction. You will have credits on that settlement statement, and those credits will come from the loan that you just established. So that loan will be a credit on the statement. The taxes from the seller side, in the state of Colorado, we pay taxes in the rears. So if you're closing a transaction, say today is December 17th, all the taxes from January 1 till December 17th, the seller will be responsible for those because they lived in the property up until that date. Those taxes will be collected on the seller's settlement statement, and it will be a credit to you because the taxes for that period of time will come due next year, and you will own the house and have that bill come to you. So you will have a credit for taxes that come from the seller's side to your side. You will also have a credit for the earnest money that you offered. Your down payment will then kind of come and calculate out of that. On average, closing costs for buyers is about 1.5% of the purchase price of the home that you're buying. So that's a good estimate of money that you can have set aside. Now, can somebody else pay for some of those closing costs? Let's talk about that. Now, working with your realtor, you can ask to have seller concessions placed on the contract. which means we're going to ask the seller to provide money towards the closing costs. It could be $3,000, it could be $4,000, it could be $1,000. Anything that comes from the seller's proceeds, they're going to offer to you as closing costs. Now, depending on the type of loan you have, certain things are allowed to be paid out of that money and other things cannot be paid out of that money. But you can ask for what's called seller concessions, and that can help offset some of the cost of the closing costs. However, depending on the type of real estate market you're in, that might not make your deal look so great in a multiple offer situation. So our current market, we are December of 2020, we are in a strong seller's market, which means it's really hard to find a house. There's very few properties listed and many more buyers. So it's supply and demand. So there's usually multiple offers on properties. And when we are entering a multiple offer situation, asking for closing costs can be challenging. So I just want you to be aware of that. Depending on the type of real estate market we're in, asking for concessions can be challenging in a multiple offer situation. Closing costs with a VA loan, depending on how much down payment you put. Now, I know, a lot of times you think, well, the VA, I don't have to put any money down, and you don't. But the funding fee for a VA loan is much higher when you don't put some money into a down payment. You can actually lower that funding fee way down if you put as little as 5% down into the loan. So if you're doing a VA and you're not putting any money down, your closing costs will be a little bit higher based on the funding. If you have less than 20% down, some loan programs require private mortgage insurance. And that's an additional fee on top of your payment that I'm sure at this point of closing costs you would have already discussed with your lender. However, those fees are calculated into your payment amount. And so PMI will be something that doesn't necessarily adjust your closing costs, but it will adjust your payment. So let's recap. There are credits and there are debits on the settlement statement, and the closing costs are calculated through that. So the debits, as we reviewed, were the loan that you received from the lender, the earnest money that you put down in good faith at the point of contract acceptance, and the taxes that the seller owes you for the time that they lived in the home during this year. So that will be the credit. The debits will be the lender fees, the title company fees, the escrow account buildup, the property insurance, the HOA fees, if any were due, and all of that's going to calculate out to be the closing costs. As I estimated before, it's 1.5% unless it's a VA loan. And then it could be significantly higher if you put zero down, or if you put as little as 5% down on a VA loan, that VA funding fee can be a little bit less. So that's the gist of what is included in the closing costs. When they are paid is at the end. Who can pay them? Well, if it's depending on the real estate market that you're in, sometimes the seller can assist with some seller concessions and they can help with closing costs. So hopefully that answers all of your questions and that helps you with a little bit more understanding of what is involved in this part of the transaction, but they are necessary. Basically, you're paying for the transactional costs at the end of the transaction. Now, if you found value in this video or you'd like more information and a first-time homebuyer's guide, then click the link below and I'll be happy to send that to you. Like and subscribe to my channel and check out some of the other videos I have on my YouTube channel to help educate you on the first-time homebuyer's process. Thanks so much for watching, and I hope you have a fabulous day.